The other disclaimer we kind of want to throw out here that differentiates HELOCs and private loans, private lenders going into a second position, like we've discussed, you're going to pay a lot more money for a second position loan to a private lender.
Welcome to the Good Stewards Podcast, the only podcast dedicated to seasoned real estate investors who want to maximize the cash flow potential in their business. We are buy and hold investors with 1,000+ properties and markets across the U.S. who bring an insider's view into the nitty-gritty details of real estate investing. If you're looking to develop the mindset, teams, and systems that can dramatically build your real estate business and net worth, you're in the right place.
Welcome to this episode of the Good Stewards Podcast. I'm Ryan Dossie.
I'm Amanda Perkins.
I'm Bill Sirius.
And I'm Andrew Sirius.
Hello, Good Stewards. Today we're going to discuss how you could strategize with a HELOC, home equity line of credit, or second position liens that ultimately can impact your cash flow and reinvest into your company. We're excited to cover this topic because it's a strategy we oftentimes use in our business. It's something that can help us access cash immediately to further our real estate investment. And there's a time and place for all of it, and it works great for us. So lots of different things to talk about. Let's just go over what a typical home equity line of credit would be. It's probably something every time you walk into maybe your local bank, there's a sign out and they're pushing it, and they'll have like a little sign and it'll show like a new boat or a new car or something, and it'll say something like, use the value of your home to take cash out of your home. Fund your dreams.
A boat is the wrong use for a HELOC, just so we start this off on the right foot.
Right. But it could be a really great way for you to maybe pull out the equity and turn it into cash into your home and use it to maybe make your first property purchase. Maybe you could use it as a down payment, that sort of things. What we like about it oftentimes is that they start off interest only, usually for 10 years, and you only pay interest on the money that you draw out as you draw it out. And so it can be a really affordable way for you to further your real estate investment.
It's kind of like a line of credit that you kind of only pay for it when you use it instead of a lump sum you're paying on while it's just sitting there.
Absolutely. And banks oftentimes will offer you maybe a personal line of credit. The interest rates are oftentimes higher. And the reason why the home equity can work great is because the interest rates are pretty low and it is tied to your home value. After the 10 years, they oftentimes roll into an amortized loan. And you'll want to be careful about that because it usually is an amortized over a 15-year loan. So if you maybe the bank offered you $100,000 home equity line of credit, and you took all of that and you paid interest only at a very reasonable rate for 10 years. At some point, probably after 10 years, they're going to turn that into a 15-year amortized loan, and you'll be paying more than the interest. So your payment will go up significantly.
Can we say that you're absolutely a bad financier if you use this money for bad debt? And how would we define the difference between good debt and bad debt?
Well, typically consumer debt would be what we would call bad debt. And a lot of people would use that maybe to consolidate car loans, boat loans, RV loans, credit card debt, and tie it to their home. If it lowers your monthly obligations and you're not utilizing it for, real estate investment, but you're utilizing it for debt consolidation, it's not the worst thing in the world, especially if you can take, $2,000 of payments and lump them down to $750 of payment and give your family more room to do other things. The thing to consider is not to go and replace that debt
Not
you
to go get a new
consolidated.
Porsche.
I think that's the two good ways to look at it would be, one is if you're reducing your interest payments on other debt by consolidating it, or if you're using that debt to buy an underlying asset that will appreciate or bring in a return that's higher than the interest rate of the debt that you've accumulated, and also is not that risky too. That's an important point. So if you're buying furniture renting furniture from Rent-A-Center or whatever, or televisions on zero down or whatever, and or boats, that's all not good debt.
I think one of the important distinctions to make here is, even if you're going to use this for investing, you're going to have to pay it back. So you have to make sure that you're using it very, very, very wisely, that you're getting a good deal, that it's something you can refinance out of. And you also want to make sure you're not putting yourself in a position where a bad investment can cost your family their home, right?
Absolutely.
That is the kind of the belly of the beast of what we're discussing here with a home equity line of credit, is if you don't make the payments on it, you lose your house. So when you're considering, hey, is this something I want to do? There's a lot of people that you want to be pretty smart. There's a lot of investors who buy a deal that doesn't cash flow, or buy a property that they lose money on. So if this is the only source of capital you have, and you're going to go try to become an investor with it, you have to be very, very careful that, you don't end up on the streets because you got too eager and jumped in too quick.
Can we all say that we're Dave Ramsey fans, except for one issue, and that's how he looks at real estate investment. He does not necessarily see that as a positive thing to go into debt and leverage yourself. However, if, as Ryan was talking about, if you do so carefully, leveraging yourself is the way to build wealth. And actually, real estate is one of the very, very, very few ways that a person can wisely leverage themselves and use a lot less of their own money and a lot more of other people's money to multiply their assets over time through real estate.
I've heard buying stock on margin has no risks whatsoever, and has never had any negative consequences.
I think a good example of what not to do with a HELOC is people that took HELOCs to buy Bitcoin at the height of it, right before it crashed. Congratulations, you have nothing and you owe your bank more.
Absolutely. So one of the reasons why you would, maybe consider this as an option instead of refinancing to get the cash out immediately. Well, first of all, getting a home equity line of credit can be really, really quick. I mean, something that you could probably pull the trigger on in 10 days. It requires less paperwork. It's just because of the product the bank is peddling, but it's more like they look at the value of your home pretty quickly. Sometimes there is an appraisal involved, oftentimes not. And they're probably not, the bank's going to have an idea of how much they're comfortable extending you on your home. Also, if you just bought your house, you're probably not going to qualify for a home equity line of credit. This is really something that if you've owned your house maybe 5 to 10 years, there's been appreciation in the market. This is a way for you to access that appreciation and that equity in your home and in a tangible way, rather than selling your house or refinancing your whole house to get to it.
It's also a flexible way because you can go up and down as you need it. Indeed, actually, this is a bit of a tangent, but one method for raising private loans, although this is something to be cautious with, is somebody who has equity in their home can take out a HELOC, lend it to you at a higher interest rate, and then once you pay it off, they can just pay off their own HELOC. So that's one strategy for perhaps finding people with private money, but that kind of plays into one of the key advantages of HELOCs, and that is the flexibility angle that they provide.
I think on that note, that's actually how a lot of hard money lenders run their businesses. I've got a buddy out of St. Louis who's a hard money lender, and he's got a line of credit for a few million at 3 or 4% interest. And he turns around and lends it out at 9 and 10 with a few points, right? So that is kind of another, we briefly touched on using debt to make more money. That's kind of another example of that.
We have
a
friend who's a retired insurance salesperson who made good money, and he's got great credit, and he does the same thing. He loans stewardship money, as a matter of fact, 8 to 9%, and he gets it at 2 to 3 to 4% because he's got such good credit. And he just makes on the margin. He works the margin all day long with that.
Not a bad retirement plan.
So one thing HELOC is more of a residential mortgage product that once you cross a certain threshold, maybe you're not going to have access. For instance, in stewardship, a home equity line of credit isn't something that is a product that we can tap into. But what we do use, and this is a different thing than a home equity line of credit, is we will sometimes put second position private lender debt behind our first position mortgages. And the reason that we would do that is, say, for instance, we have a loan that on a property and maybe it's 10 or 15 years old. It's paid down a ton. The property is appreciated a lot in value. And we don't necessarily want to refinance it immediately, but we'd like to use that equity in that property to invest in another, maybe repairs on a property, or maybe, buy another property with it. We'll pull the trigger and go ahead and put a private lender behind an old mortgage or something. And, we run the numbers. We make sure that, we're not over leveraging ourselves. We make sure that, adding that second loan payment isn't going to completely take away our cash flow ability, because oftentimes those first mortgages that we put in place that are older, rents have raised over the time that we've had the loan in place, and the values have raised. And so there's room in our cash flow and the equity of the house for us to put debt behind it. So it's something that works for us. The other reason that we do it is not always, but sometimes banks will refinance a property and pay off debt, but they don't necessarily want you to be able to have cash out of a refinance. We have good relationships with banks. They're oftentimes pretty okay with us refinancing and getting cash out based on, the appreciation that we felt by owning a property for a long time, that sort of thing. But by putting a second position on it and taking that cash and furthering our investments, we basically guaranteed ourselves a cash out position because the bank won't even bat an eye about paying off debt associated with a property as part of a refinance.
That's what we call a loophole.
Yeah. I mean, we don't do it.
Another use that we've seen and that we've used is on properties that come seller financed. So there's kind of this myth that seller financed projects are a great way to get started. The problem with that comes when they need money or when stuff breaks. If you don't have any cash to begin with and you had to use seller financing to get into a deal, what do? So what we do when we're negotiating seller financing, which honestly we don't always view as a plus, we will basically do a land contract, is how it's structured in the state of Indiana. And we'll pull in a lender in a second position to cover things like capital improvements, renovations, anything we need to do to be able to turn the property, to be able to refinance that eventually. So that's another kind of structure for some of these second positions. I think the other disclaimer we kind of want to throw out here that differentiates HELOCs and private loans, private lenders going into a second position, like we've discussed, you're going to pay a lot more money for a second position loan to a private lender. We're getting money typically at 8-9% to talk somebody into a second. We're 9-10. I mean, it kind of just, you're headed more up there because for a private lender, there's not a ton of, there's recourse, but it's not nearly as secure. So in order to get somebody to go into a second,
it's tied to the property and they can still foreclose it, but they're subject to the first loan in front of it. So
correct.
Yeah. So if we'd stop making that payment, they're going to be the ones that would have to do the foreclosure, but then they're still going to owe the money in front of their loan.
So their question is, what is the first? How much is it for? What's the value of the property? What's the cash flow of the property? They should know all these things going into it so they have their eyes open regarding their second position. Seconds aren't bad, particularly if there's a strong amount of cash flow in this property. It's got a good history of rental history. As a matter of fact, I've had up to a fifth before, if you can imagine that, which
generally speaking, we do not recommend
that's how
that.
you know someone has some serious faith in you.
Here's the nice thing, though. As you pile on a second or third, that makes sense. Then you're going to pull the trigger and do a bank refinance down the line. And that's often what we do. So we'll put somebody in second position, and then that might go for a year, might go for 2 years. And then we go ahead and go back to the bank and pull a refinance. Now, the reason we don't do these bank refinances too often is because the costs are fairly substantial. You've got an appraisal, you've got at least a half a point from the bank, you've got title insurance,
title fees, loan fees,
so on and on and on. That's why these seconds are pretty helpful, because you don't have all those extra fees. But then over time, you want to get into the BRRRR method, and that's the BRRRR method, which is BRRRR. In other words, it's refinance and repeat, refinance and repeat. This is over 10, 15, 20, 25 years. You keep refinancing and repeat because, and maybe you update the property, maybe you do a little extra rehab, but the reason that this is so powerful is because, one, the money goes back to the private lender and they have funds to loan back to you. And oftentimes they have motivation to loan back to you on another property because they want their money working and they've seen that you've done what you said you've done. And also then all the money that you would get in over time on these refinances is all tax-free. Now, of course, it increases your debt obligation, and with that, your mortgage payment obligation, and your cash flow can go down as a result of that. But this money can again be leveraged tax-free. And that is another very powerful tool of refinance in real estate.
We're definitely fans of leverage.
That being said, it's a two-edged sword, and it's something to be very careful with. Normally speaking, I wouldn't be just piling up seconds and thirds on your properties unless.
Why don't you tell about the first number of loans we got in Kansas City, Andrew, and you're on the precipice now of refinancing. This is kind of an interesting story.
The first loans we got here from banks or from private lenders?
Yeah, from banks. Mm-hmm.
Well, the first ones we got from banks took a long time to get just because nobody wanted to lend to us back in 2013, 2014. And I mean, the idea of getting a HELOC at that point on anything we had was just absolutely out of the question. But we eventually got some loans from a bank that lent to us 15-year AMs, 6.5% interest after 2 years of seasoning. So they wouldn't lend on the appraised value unless we'd owned it for 2 years. We finally got those finance, basically paid off private lenders that we had. We had compiled a large number of private lenders on these properties and finally got those started to go through with just one bank. And then finally around 2015, 16, we really started the floodgates open. We started getting a lot of different properties financed from several different banks. But yeah, I mean, right now we're looking to refinance some of our first original loans and pull out some money and move that debt to from 15 to 20 years, probably reduce the interest rate a little bit and pull out some of our equity, which is what happens in an appreciating market. One of the reasons real estate can be very powerful. That being said, we have had the wind at our back a little bit. And so I do always recommend some caution whenever you're dealing with debt.
You still have to cash flow.
Absolutely.
Yes, absolutely. That's a key point.
That's what buried people in 2007 is they're just getting money. And it was almost like the property was kind of an anchor to that cash, but it wasn't self-sustaining. It was just sinking.
It was like they were doing Bitcoin. They're buying it to flip it, which is like, that's a bad sign.
And they were assuming appreciation, which is always the icing on top of the cake. It's never part of the cake itself. You'll take it when you can get it and be thankful, but you never assume it.
Well, and when we're considering something that you can be a second position, it's oftentimes it's like, and we do still have some of these properties in our portfolio. We only have maybe $125,000 or $150,000 first position mortgage with a very small payment, high rent, and the property is worth $300,000 or $350,000. So that's a real easy sell because there's a huge amount of equity there for our private lender to understand, like the margin there of it, because we always are trying to pitch to them, the worst case scenario, you have to sell this property. This is how you get paid back. So, and then because the rents have increased so much and the first loan payment is so low, there's room there. So we're always making sure the equity's there, the cash flow's there, being mindful of the terms that we offer on the second position, because, it's just maybe not something that's going to be ready to refinance. We have a situation in Texas. This is a different reason for us to get a second position, but we have an apartment complex with a long-term, I think we're 3 or 4 years into a 12-year loan term with pretty onerous prepayment penalty. So refinancing the property at this moment in time isn't feasible for us. But over the last 2 years, there were some things happening in the city, and we got some money from the city, but we had to do some pretty significant upgrades to our property. In this case, it was $600,000 that we had to put into our property that we'd like to be able to tap back into. It did increase our the upgrades we did on the property did increase our NOI, or net operating income, which would allow us to probably refinance and get more money out of the property. But going back to that, we're locked in for a 12-year loan. So in that case, we're probably going to get a second position behind that first, because we do have an increasing cash flow, but we're just not able to refinance our first at the moment. So there's different reasons of why we do it in different situations. And in that case, it's just, we're stuck with we have a great first position loan there, but there's nothing we can do about refinancing our improvements out of the property. And we'd like to do that.
And that second could be a private lender, but in this case, on this apartment complex, correct me if I'm wrong, Amanda, this is an FHA product, right? That allows people to go into second. I mean, they actually anticipate this issue that people, investors don't want to refinance because of the onerous prepayment penalty. So they've set up a situation where you can get a second at a very good rate and put it behind their first.
Which is another, just one more thing to be mindful of. So oftentimes with our regional bank commercial loans, they're pretty strict about subsequent debt. What that means is they want to be the only loan on the property, and they don't want you to put any debt behind them. So you need to make sure you are following the rules with that, so that you don't get your, because what they can do if you did go and put debt behind them that they didn't want, they can call your note. So you would be forced to refinance or pay off that debt behind it. So you just want to be really mindful of which bank products are going to allow you to put a second behind them. Like, for instance,
and what you take in the first place. I mean, I think you operate from kind of a position of power when you have options. You're operating, not so well when you need to get a mortgage or you need to get something refinanced. It's, I think, kind of one of the reasons that we actually talk to local community banks as opposed to going through some of the kind of national, cash out refi landlord products, because we can pay 5%, 5.25% instead of 7%, right? And the points are lower. So it's, I think it just kind of comes down to looking at the big picture of, what could we foresee coming up? And when you guys took that loan on that complex, that may or may not have been a consideration, but as you're looking at options, read the fine print, make sure you know what you're agreeing to, and also make sure you really play by those rules. For anybody who doesn't know, calling a note due, which is what Amanda mentioned, is the bank literally saying, okay, you have to pay us off now. And the time frame for that varies, but I believe it can be as short as 30 days.
It can be.
Depends on your paperwork. So it's one of the other reasons we're pretty careful with kind of the the subject to strategy, right? I'm going to buy your house and make your mortgage payments for you. 99% of the time, that's you are actually violating the terms of the mortgage. Now, whether or not that gets called or not is up for debate. really just depends on the bank, but you want to make sure anytime you decide to maybe walk a gray line, you can afford to pay it off if that's what you're going to try to do.
Most banks don't care as long as they're getting paid, but I have heard of them calling it, and they have the right to call it. And that's just something you have to keep in mind and understand, and also be open with the seller. I mean, you shouldn't hide that from them.
That's key, because most people that are doing subject to are not in a position that they can cash out.
Well, we're actually doing a subject. We have done a subject to a couple of years ago, and the person we did it with is now seeking to get their own loan because they're buying a house themselves. Now they can't have this debt on their credit. So we are in the process of now refinancing that property in order to pull off that debt from being tied to their name. And you need to be prepared to do that. So I would not say subject to is a bad thing. You just need to be prepared for the consequences of if you have to refinance, if you have to pay off, if you have to sell, you're prepared to do that rather than put the person that you borrowed the money from or has their name on the loan still put them in jeopardy of some kind. You just can't do that. You got to be prepared.
Moral of the story, leave people better off than you found them.
Right. Well, I won't dwell too much on our taking over a mortgage for someone, but oftentimes the initial borrowers that we're buying the house from is in bad shape financially. So it's not oftentimes that they're going to go down the line and buy their next house and get a mortgage. And actually us making payments on their mortgage timely for years and years helps them out. In this case, this seller wasn't in financial dire straits. He had good credit and good payment history. He just was relocating for a job. So it worked out.
Well, and even if they are in rough financial shape when they come to you, that doesn't mean 5 years down the road, they're not going to want to buy another house. They're not going to have improved their financial circumstances or whatever.
Absolutely.
Bill, let's transition to you. Just because I've seen some of the back and forth on this, selling private lenders on going into a second position. How do you do it?
Well, I think it starts with what Amanda's talking about. You have to have a good product to sell them on, and that is a product that has equity in it and a product that's cash flowing. So that property needs to speak for itself to them and say, this is a solid place to go into a second position, because that's an uncomfortable position for many people. Over time, we built up such goodwill in our company that people don't generally have a problem going into second position. They have more of a problem not having their money with us and getting the kind of interest rate that we provide. So
that's a good problem to have when your private lenders are upset that you don't have deals to put them on.
So to do that, you need to be just square, upfront, straightforward with people, act with integrity, and be honest. That doesn't mean that your Uncle Sam and can print money if a really bad thing happens, but it does mean that you will talk to them every step of the way if, in fact, you get into some kind of financial trouble, and not leave them on the sideline.
I think the key thing to highlight kind of between you and Amanda both on this isn't like a shady tactic that we're using. We are making sure that this is a good deal and will still be a good deal, even with the second position behind it. I feel like a lot of people could potentially, try to use this to just get extra money and tie it to something to then, rob Peter to pay Paul or whatever. So I think that's kind of an important thing to highlight, is that when you guys are asking a lender to go into a second position, there's a good reason and it makes sense. It's not just like, we could use an extra $600,000 in Texas, so this thing doesn't cash flow, but give us a loan.
And again, it's all about good debt versus bad debt. If you're using the funds and capital that you're raising for an appreciating, cash flowing property, and you can show that, then you're probably leveraging in a very wise way. So I'd say, what are you putting the money into? Never put it into something that we call bad debt, or Dave Ramsey would be against, other than real estate. So I just think it's kind of like one other thing that I would say is that you always record the trust deed or mortgage against the property that you're putting the money on. So you don't borrow money and tell somebody it's going to go into second position and then not record the trust deed. People have gotten into real problems, and it's been super shady, is they borrow money from Peter and then Paul and then John and then George and then Ringo, I guess. And then they never record it, and they're just borrowing money on a phantom. And that is so shady, inappropriate.
That's what gets you in jail. I think the other kind of important distinction you guys have both made that I think is important for people that are just starting some of their private lender relationships is this is all done on relationships. These are folks that have seen our payment history. They've worked with us long-term. They know we're good for it. I think it's a little bit harder to come swinging out the gate like, hey, my name's Ryan. I know we just met. How does a second position loan sound to you? Right.
Well, right. And not only that, it's a second position loan isn't something that a newbie real estate professional is going to necessarily have the equity to work with because, this is something that over time you can build. I sort of wanted to transition. This came up. One of our subscribers reached out, said they're trying out a HELOC because they have a way to refinance out of it quick if they need to. And we're wondering about the pros and cons overall, in our opinion, of using a HELOC. And pro right off the bat, quick, easy way to tap into the cash into your house. I'm all for them. I wish it was a product that we could easily access because the rates are usually great. The interest only payments are great. The real con of it is, I think, is just, once you get to that seasoned 10 years down the line is usually that magic number. Just if you're out on your line of credit, be prepared to either start a new one if that's something the bank is offering to pay off the old one, or be ready for your payments to go up. But that's 10 years of interest only payments, which for a cash flow business works out great. It's just, something that down the line at some point the bank will want you to pay it back with the principal. So
I think some of the cons are, you are risking your home.
Yes.
So as Amanda mentioned, in a cash flow business, it's great. So make sure you're cash flowing. Don't go pull out a home equity line of credit and, use it for something dumb. Don't pull one out and buy a deal that doesn't cash flow, but you're hoping it'll appreciate. Even if it's like, wow, I think this area is going to go up in the next 10 years. None of us have a crystal ball. Make sure you're cash flowing. I would also say, make sure it's something you can get it back out of. So that's one of the reasons why we focus on getting such good deals is if we need to pivot and sell a property, we can. If you were to say, go and invest it with somebody else, and maybe you didn't vet that deal properly or something, and, you're not really getting paid on it, you now have a liability. So I think for me, my other thing is if you're going to do it, I would be the one in control of the asset, especially if it's your first one. I wouldn't go and become a hard money lender with your home equity. I wouldn't go buy turnkey properties. Make sure I'm getting good cash flowing deals that are easy to liquidate should I need to down the road.
I think it's a really good point. Don't be investing out of state with this money. Be in control of it, as Ryan says. So you're doing the deal. You have control over it. Maybe once you build up a lot of other assets, then you can think about going out of state and being a hard money lender. But that's kind of down the line.
I think one distinction I'll make on that, people, when they get money easy, they tend to value it less. So when you just happen to live somewhere and make the payments and somebody cuts you a check for $100,000, that's not free money. Like, don't view it that way. View it the same way as if you worked and, saved, $1,000 a month every month or whatever it is and got up to that dollar amount. How cautious would you be with that funds? Because $100,000 is $100,000. You're going to have to pay it back. And I've seen particularly new investors, fix and flippers, they do a deal. All of a sudden they have a lump sum of cash and they're just like, oh, gosh, it's just never going to run out. And then, they're 3/4 of the way through a rehab, home equity line of credit's dry, and they don't have a way to get it across the finish line. And now you have a liability.
Isn't it Warren Buffett who says there's 2 rules to investment? The first rule is don't lose the principal. And the second rule is don't forget the first rule.
Absolutely. I think that's about what we have for time today. Thanks for tuning in. If you liked what you heard, remember to like and subscribe to the podcast and get your free copy of our ebook. Visit thegoodstewards.com for more information. Connect with us and submit any questions or topics you'd like us to talk about. Thanks for joining today.